Welcome to another video by the Athenian Bull, and today we are going to talk about the top 5 US stock market crashes. What caused them, their impact, and recovery. The US stock market has seen its fair share of highs and lows, but some moments stand out as defining crashes that reshaped the financial world. Today, we're diving into the top 5 US stock market crashes, uncovering what caused them, the impact they had, and how long it took for the market to bounce back. Let's get started. Our journey begins in 1907, a time when the US didn't even have a central bank. The Panic of 1907 was triggered by a failed attempt to corner the market on United Copper stocks. This collapse led to a domino effect, with banks and trust companies falling like dominoes. Without a central bank to stabilize the system, panic set in. People rushed to withdraw their money, and the financial system nearly collapsed. J.P. Morgan personally organized a bailout by pooling resources from private banks. This panic didn't just expose vulnerabilities in the financial system, it also highlighted the dangers of concentrated financial power. Public distrust of banks surged, fueling demands for structural reforms. The market dropped by over 50%, shaking public confidence in the financial system. It took about a year for the market to recover, but the panic ultimately led to the creation of the Federal Reserve in 1913 to prevent such crises in the future. Next, we jump to 1929, the most infamous crash in US history. The Roaring Twenties had seen an unprecedented stock market boom fueled by speculation and easy credit. But all bubbles burst. On October 29, 1929, Black Tuesday, the market lost 12% in a single day. Over the next 3 years, it plummeted by nearly 90%. The crash wasn't just a financial event. It marked a seismic shift in how Americans viewed the economy, leading to widespread unemployment and a dramatic increase in poverty levels. Industries collapsed, and millions of families were left destitute. The crash didn't just devastate Wall Street. It marked the beginning of the Great Depression, leading to widespread unemployment and poverty. The market didn't fully recover until the 1950s, over 2 decades later. October 19, 1987, became known as Black Monday, the single worst day in Wall Street's history by percentage. The Dow Jones Industrial Average fell an astonishing 22.6% in just one trading session. What caused it? A mix of factors, including program trading, an early form of algorithmic trading, and market psychology. As selling intensified, panic set in. Unlike previous crashes, Black Monday highlighted the role of computerized trading systems. When programs automatically triggered massive sell-offs, it created a self-reinforcing downward spiral, raising questions about the risks of automation in trading. While the market took a massive hit, the overall economy remained relatively stable. Believe it or not, the market recovered within 2 years, thanks to swift intervention by the Federal Reserve. The late 1990s saw the rise of the internet and a wave of tech startups. Investors poured money into anything with a .com in its name, regardless of profitability. But when reality set in and many of these companies failed to deliver profits, the bubble burst. The Nasdaq fell nearly 78% from its peak, wiping out trillions in market value. The dot-com bubble serves as a cautionary tale about speculative mania. Companies with no earnings and dubious business models attracted massive valuations. When these companies collapsed, it led to significant job losses and a pullback in venture capital funding for years. The crash sent shockwaves through the tech sector and led to a recession in the early 2000s. It took the Nasdaq almost 15 years, until 2015, to regain its pre-crash highs. Finally, we come to 2008, the most significant financial crisis of our generation. Fueled by a housing bubble, risky lending practices, and complex financial instruments like mortgage-backed securities, the system came crashing down. The tipping point came when Lehman Brothers filed for bankruptcy, triggering a global panic. The market dropped by over 50%, and millions of jobs were lost. The collapse of Lehman Brothers was a wake-up call for governments and financial institutions worldwide. It exposed the fragility of interconnected financial systems and the dangers of inadequate oversight of complex derivatives. The crisis led to the Great Recession, the most severe economic downturn since the Great Depression. The market began to recover in 2009, but it took until 2013 for the S&P 500 to return to its pre-crash levels. Each of these crashes taught us valuable lessons about speculation, regulation, and resilience. While history can't predict the future, it can help us prepare. What do you think is the biggest lesson from these crashes? Let us know in the comments below. And don't forget to like, subscribe, and hit the bell for more insights into the world of finance.